a mind-bogglingly low number if you have a growing business. Today, that multiple is roughly around 11 times. So we start to see a nice pickup in the valuations, which I think has caused companies to start thinking about the IPO as a financing alternative. Historically, in the last couple of years, that multiple is frankly too low. And I think in addition to all that, there's clearly been a lot of inertia that's been built up through the regulatory regime, things like CEOs and CFOs having to sign off in blood, and then obviously the cost of going public has real incremental and real tangible impact on the valuation of a company, because obviously the costs associated with going public drop to the bottom line.
And so, Barry, I know you have some stronger feelings as to why people aren't going public and why they shouldn't go public. What are those feelings?
Well, I think what most people don't realize is the IPO market has been dying a slow death over the past 10 years, and no one's really talking about it. This is not a recent phenomena where it's just a credit crisis that has resulted in companies not going public. For the past 10 years, you're seeing the number of IPOs going down.
Second market.
But what you're also seeing is the types of companies that are actually able to go public has completely changed from what it was 10 years ago. 10 years ago, and even before, you could be a company that was worth $150 million and get an IPO done and be welcomed to the public market. Today, it's $500 million to $1 billion. So the companies that are actually kind of getting out are these very, very large companies. But what it does is it creates this big vacuum that exists for all the companies, like my company, a lot of people here in the audience, that don't have the ability, don't have that exit opportunity. And so what has happened is there's been a tremendous need for liquidity for a lot of these shareholders in these companies. And what's exciting is there's a lot of demand now. And so for the first time ever, there's an opportunity to create kind of a spring training, if you give me that baseball analogy, where between years kind of 5 and 10, you can kind of grow into the point where you could then go public. And that's what second market is doing. We're trying to kind of create this new market where companies can transition out early investors, you can bring in new investors, and you can get to the point where you then have at least the option of going public versus selling your company and ultimately cutting a bunch of jobs and destroying innovation.
So talk for a second about second market. What does your company do exactly? Can I raise money through second market? What are you doing?
Well, I'm going to take a quick step back and kind of tell you how we got started. So Second Market we launched about 5 years ago as a marketplace for lots of different alternative investments. And about 2 years ago, we got a phone call from a former Facebook employee who said, I just left the company, I don't have any money, I want to buy a car, help me out. And we hadn't created this market yet, and we said, okay, well, let's see if we can find some buyers for you. And to our surprise, there were a lot of people bidding on Facebook stock without having any information at all. They didn't know the cap table, they didn't know revenue, didn't know anything. We took a big step back and said, okay, kind of what's going on here? Why is there a company, a shareholder like Facebook, not wanting to wait to the IPO? So we did some research, talked to a bunch of venture capitalists, talked to some private companies, and what we realized was that there was this growing reluctance for companies to go public for some of the reasons that Henry David mentioned. So what we decided to do was create a new market where we actually work with a company, where we enable a company to create their own market on second market. So the company gets to decide who the buyers are. The company gets to decide who the sellers are. The company decides when the market's open. So it's not a 24/7 market like this casino public market we have. For a lot of companies, it's a once-a-year auction or a twice-a-year auction. And also importantly, companies get to decide what information they want to disclose to investors. But since we're doing it in a closed environment, companies are more willing to share more information than what others.
And who are the buyers? And I presume you're not doing this for free.
We are not doing this for free. But the buyers, it's interesting to kind of see how it's evolved over the past 18 months. In 2009, the first year we launched this market, we did $100 million in private company transactions across about 5 companies. In 2010, we did $400 million across 40 companies. And the buyers were primarily institutional investors, but also it's open to individuals who meet basically the sophisticated investor test, which is unfortunately just based on money.
And how much does it cost?
So the seller pays a fee when a transaction is closed, and so there's no fees to access the market, there's no subscription fees, there's no fees to list, and it tends to be about 3 to 5% depending on how active the private company stock is.
Matthew, you have another view on this. You're looking at the United States from afar, and I think have a view that the regulatory environment there is absolutely ridiculous, and that is in fact affecting what we're talking about here.
Well, yeah, I mean, I like to use as an example to understand these issues, to think about Facebook much like you think about the government of the People's Republic of China. They want all the benefits of popular democracy whilst retaining absolutely brutal centralized control. And they're trying to explore the tension between that. They realize they need the public's money, they need the public's creativity to help themselves succeed, but they really don't want to let go and they want to snaffle as much of the spoils for themselves. And part of our problem, I think, is that as many people in America tell me, the democratic model isn't really working for politics as well as we hope, because we have all these rather stupid voters who keep voting for the wrong thing. In much the same way that democratic structures that we've created around companies and raising capital don't work either. So we have this notion of a sophisticated investor, which I think basically means you have to be clever enough to understand that if you lose money, the government's not going to bail you out. But of course, as we now know, you can run Goldman Sachs and be bailed out by the government. So all people are unsophisticated in that sense. We have a situation where we have this absurdity of the roadshow before an IPO when they happen in America, where basically journalists are not allowed to report on the roadshow. So you have this whole process leading up to the shares going public where artificial secrecy is imposed. And you have fundamentally the dot-com bubble the first time around being this moment where the public were lied to worse than any politician was ever lied to. They were told they were being sold these incredible companies. I'm sorry to bring this up, Henry, which even those selling those companies thought were crap. I had this incredible pile of baseball caps that were worth more than the companies they were advertising for all those IPOs. And we simply haven't come up with an answer as to how do you engage the public and their savings in capitalism without absolutely creating a disaster. And now second market is an attempt to solve that, but it's really only a partial solution. And one of the challenges I think we should all wrestle with coming out of this financial crisis, and which all you techie people in the room should be able to help with, is how on earth do we connect the public with capitalism in a way that's genuinely sophisticated rather than this farce that we have at the moment.
Well, see, this is a good point, now that you raise the IPO issue and so forth, is what is the job of the regulators, Matthew? Because a lot of people in the United States, especially after the dot-com bubble collapse, all during the 1990s, when the markets were going up, everybody wanted to be able to buy everything. They want to kill regulation because it's just getting in the way of me making money. Then, when the market crashes, it suddenly says, oh, it's a regulatory failure. We cannot allow investors to be stupid and lose money. We must erect huge barriers to prevent them from being stupid. So, what is the answer? What is the
let's think back about, let's take the Securities and Exchange Commission in America. In the late 90s, it was run by someone called Arthur Levitt, who spent a lot of time going around telling the public that they were being sold rubbish, but then didn't feel he had the power to do anything about it. He was replaced by a lawyer who basically hated the press, and then by the head of Donaldson, Lufkin and Ginrette, an investment bank who didn't do a very good job after that. Then we had a former politician who basically believed his job was not to regulate, even though he had regulatory powers. And now, I don't know what we've got, it's a complete farce. So the job of the regulator, I think, should be about helping the public to be informed, making sure that there's truth in advertising, and trying to engage public as much as possible. At the moment, it seems like it's certainly in America, a real mess. And what you have is these periods where that you have a lot of optimism, and so the politicians won't touch the capital markets, and then something goes wrong, and then they come in with a whole load of regulations that clearly the politicians themselves don't understand, which make life worse. So you have this situation where the rules that were brought in under Sarbanes-Oxley after the crisis at the start of the last decade basically shut down the IPO market, so made it harder for the public to invest. And now I think this new Dodd-Frank legislation is even more of a dog's breakfast, so it's any idea what's going to happen to the efficiency of the markets now.
Yeah, it's been interesting to kind of see what's happened as a result of a lot of these rules that were enacted over the past 10 years. If you look at the public markets now in the US, upwards of 60% of trading in the public market is being done by high-frequency traders, which is basically these computer algorithms that are driving all the volume. 10 years ago, it was like 5%. So that's scary alone. I mean, you look at the flash crash. Were you guys watching TV on May 6th? It was pretty scary to see the market do this. It came back a little bit, but But as a result of high frequency trading now, the average hold time when someone buys a share of stock in the market in 1970 was 5 years. 5 years. Every decade it went down by a year. So today it's less than 3 months. So what it means is if you are the CEO of a public company and someone is buying your stock in the market each day, the chances are it's a computer and it's going to hold on to it for less than 3 months. So what it means is the buyers do not care about what we are doing as CEOs, thinking 1 year, 2 or 3 years out. The buyer wants to make sure you're going to beat earnings for the next quarter. And to me, that's a broken market structure.
So, David, is that true? Is it just a terrible idea to go public because you have these greedy investors who are just only worried about the next 3 months, and then you can drive the company over a cliff and that's totally fine and who cares? And we should all go do things Barry's way and just have a 10-year horizon and so forth.
No, I think it's critically important that we have a healthy IPO market and that the best companies do pursue that as a financing vehicle, because if you look obviously at the venture capital industry, a lot of branding, a lot of high returns are generated through companies that go public, and ultimately VCs can hold on to their position for a long period of time. So I do think that we need to solve these issues, and I think that in general we're starting to see some traction in the market. It's tending towards the larger cap companies. There's some very interesting transactions in the market right now. One we're not involved with is Nielsen, which is a pretty large scale IPO, $1.5 billion IPO. And I think that will be a little bit of a canary in the coal mine in terms of the market. But I don't disagree with the panelists in that, you know, the regulators always tend to over-index, and the pendulum, I think, has swung a little too far. I think we're starting to see that retrench a little. But volatility in the market is here to stay. One of the things that we also track, which I think has also caused less IPO activity, is the IPO windows are much tighter now than they've ever been. You know, you can see a market environment that is optimistic 1 month and then pessimistic the other. Because there's so many exogenous shifts that occur in the economy and the global marketplace that have a direct impact on the IPO market and people's willingness to take risk, that fundamentally there's going to be a lot of volatility. So when we counsel companies on pursuing the IPO route, we spend a lot of time talking about the volatility, the quarterly earnings, all the challenges of being a public company. And look, the IPO option for financing and ultimately for liquidity, frankly, is a relatively privileged crowd. You know, there's only really a handful of companies that we believe have the rigor and the discipline and the business model to ultimately be a public company. The vast majority of exits, the vast majority of companies are going to reach liquidity through an M&A event. And that's generally where guys like me make most of our money.